What's up, everybody? This is Sunko, the Korean bro. Today is 2023, January 6th. And let's see, okay? Three top US stocks to watch in January is Victoria's Secret 2022 slow down a blip or a long term problem. Should you invest in Chipotle Mexican Grill right now? The smartest dividend stocks value at $400 right now. Wells Fargo has always had a similar investment banking operation, but that's changing. Mm. Is Tesla stock a buy now? Tesla is cutting prices. Here's what it means for investors. Two growth stocks are once in a decade buys and not the bear market. Two FANG stocks to buy handle first in 2023. And one to avoid like the plague. Down 69% in 2022 is NEO stock a buy for 2023. Where will Rivian automotive stock be in 1 year? Warren Buffett's biggest buying spree in the 21st century came with an interesting twist. Five stocks Warren Buffett is betting big on for 2023. Let's see. Let's first start with Victoria's Secret. Victoria's Secret is clothing store that I've been to when I was in States, and it's a store where they sell women's underwear. So hardly did I ever visit, but then I had a chance to look at it because I just I walked. It's not like I went into the store, but like I ran beside the store. So anyway, Victoria's Secret was recently spun off from a Bath and Body Works, in a so-called good company, bad company move. Having struggled for a few years, Victoria's Secret has been able to focus solely on righting the ship since it split off. Results from the third quarter of 2022 suggest that more work needs to be done. Yeah. Victoria's Secret is staple in malls around the country and world, but it has only recently become a standalone company. The reason for this is less than desirable in some ways, but it has all the management to focus all of its energy on returning this iconic brand to growth. Things could be going better. Good company and bad company. Hmm. Tough new year. Okay. Despite some early indications of success following its spin-off, results in 2022 suggest that Victoria's Secret has yet to right its business. It is making a lot of changes, including partnerships with new designers and buying competitors, including the recent acquisition of an online lingerie retailer. Still, most investors will likely want to see a more lasting improvement before investing here. Good management intentions alone aren't enough to make this struggling retailer a good investment. Okay. So good intentions, good management or loans aren't enough. Aren't enough to make this struggling retailer a good investment. Okay. Should you invest in Chipotle Mexican Grill right now? Chipotle posted strong financial results in its most recent quarter. The Mexican fast food chain still has a long growth runway ahead. Its shares fell in 2022, but still trade at a steep valuation multiple. Hmm. This restaurant company is showing its resilience as other business struggle. Chipotle Mexican Grill saw its shares in 2022 down nearly 21%, underperforming the broader S&P 500 index, which was down about 18% on the year. You can't tell by looking at the stock performance, but the popular restaurant chain continues to post solid financial results and still has tons of growth potential in the years ahead. Does this make Chipotle a smart buy right now? Let's take a closer look to find the answer. Hmm. Recent results. In its 2022 third quarter, Chipotle generated revenue of $2.2 billion. good for a 13.7% increase from the prior year period. Same store sales, which measures the comparable revenue for stores open at least 13 months, jumped 7.6%, and diluted earnings per share increased 28.1% compared to quarter three 2021. Mm. While it is difficult to predict the macro impact on future spending trends, we know our value proposition remains strong and we experienced the minimal resistance to our price increase in the quarter. CEO Brian Nicole pointed out during the quarter three 2022 earnings call. What the valuation? Well, let's look at this. Chipotle is undoubtedly a wonderful enterprise as its stellar financials, growth, pricing power, and brand demonstrated. So it's no surprise the stock has should rising 347% over the past 5 years, despite a drop of about 20% since mid-September. For comparison's sake, the S&P 500 produced a total return of just 54% over the trailing 5-year period. As a result, Chipotle currently trades at a price earnings ratio of 48. This valuation expensive even when considering the company's outstanding growth potential. For investors focused more on the value side of the equation, buying shares today is probably off the table, but for those who care primarily about growth, Chipotle might deserve a closer look right now. The best thing investors can do right now is simply wait for Chipotle's price to pull back meaningfully before adding it to their portfolios. So the author's point of view is that you should wait. Of course, it's a growing company and it's got a lot of potential, and they've been making a lot of profit in the past 5 years compared to the profit uh, made in S&P 500. S&P 500 we had like 54% over the 5 years, but then we had 347% over the past 5 years. Uh, so so what you have to do as an investor, simply wait for Chipotle's price to pull back, and before you can add it to your portfolio. So, mm, of course, I myself love a Chipotle because I ate a lot when I was in States, but I'll just wait. Okay, the next article we have is mm, Qualcomm analog devices, Intel. Mm, let's first read about Qualcomm. It's what I covered long time ago, like a couple of months ago. I covered it, but then for the past months, it's not been covered that often. So I'm just gonna go over and see what this author points out. Okay. Okay, wireless communication specialist Qualcomm has a long history of consistent dividend payments and has systematically increased its dividend over time. The payouts have tripled in 10 years. The company has strong financial foundation with a 45% return on invested capital over the last 4 quarters and somewhat uneven but reliably positive free cash flows. That robust flow of cash profits is fertile ground for continued dividend increases. Its all-time high was about $180, and current price level is $120. Uh, let's see. The most of Qualcomm semiconductors end up in the telecommunications sector, which tends to be relatively stable and resistant to economic downturns. People need their cell phones, after all, and many companies specialize in finding innovative ways to make use of mobile data networks. As a result, investors can expect a reliable stream of dividends from Qualcomm. The stock is also trading at the penny pinches the valuation ratios in decades, and the dividend yield has nearly doubled in 52 weeks. Hmm. So, what this author thinks is that Qualcomm gives you a dividend continuously, dividend wise, and since you have no option but to have a cell phone, and wherever we go, we bring cell phone, right? And Qualcomm is what makes mm, cell phone innovative because Qualcomm specializes in wireless communications. Mm, mm, I'll have to have some second thoughts about investing into Qualcomm because I don't know much about wireless communications. I'm more of a uh, making programs. So next one we have is analog devices, and the one other we have is Intel. I'm just gonna skip analog at this point. Let's briefly cover Intel this time. Traditional king of the castle industry giant, Intel, is on fire sales these days, with shares trading more than 50% below their 52-week highs at just 8.5 times trailing earnings. There are solid reasons for Intel's price drop. Of course, the company is operating under relatively new management, untangling the mass left behind its forebears. Mm, mm. Let's skip Intel too, okay? Mm. Okay, this one. Okay, let's go. Tesla. Mm. Amazon stock has gone practically nowhere for 4 years. Amazon 82. Two. Uh, we have Amazon. We have okay. First, we have Amazon. But the business has grown substantially during that time frame. Amazon stock is out of favor because the short-term outlook is cloudy. Okay, Amazon is the complete package at a good value. Set a record as the world's first public company to lose over $1 trillion in value. Mm. The stock is up just 14.4% in the last 4 years, and is down 54% from its all-time high, heavily underperforming the Nasdaq Composite and S&P 500. However, Amazon's wide moat, innovation, industry-leading position in cloud IT infrastructure, and e-commerce make it a business that could one day become the most valuable publicly traded US-based company. But to get there, Amazon needs to first boost its profitability and prove to investors that it can be more disciplined with its spending. Mhm. In the meantime, the stock could keep falling for several reasons within and outside of its control. Despite the risk, Amazon is simply too good of a company with too attractive of an investment thesis to pass up. Here's why it's my top stock for 2023. Okay, Amazon's approach is a double-edged sword. Amazon is famous for taking whatever cash flow from operations it generates and pouring it back into its core business and new ventures. The result of this strategy is that Amazon seldom generates free cash flow or net income. Sometimes the company wins big, really big, like in the case of Amazon Web Services, which is widely believed to account for the majority of Amazon's value today. Other notable successes include Amazon's acquisition of Twitch in 2014 for just $907 million in cash, a show in hindsight. Amazon doesn't disclose Twitch revenue in its financial reporting, but according to Twitch, the company has more than 31 million average daily visitors. Hmm. For comparison, Alphabet's YouTube has over 122 million active users daily, according to Global Media and Insight. YouTube ads generate over $7 billion in revenue in Alphabet's Q3 2022. It's not an apples to apples comparison, but Twitch is similar to YouTube in that it makes most of its money from ads and compensates content creators by paying them for subscribers. Amazon also bundles Prime Gaming on Twitch with Amazon Prime and Prime Video, expanding its subscription offering and making it more sticky. In addition to Twitch, other noteworthy investments include Amazon Audible, security and alarm system, um, Ring, and the Internet Mobile Movie Database. However, Amazon has also failed in obvious ways. The Amazon Fire Phone was a massive disappointment. Recently, there's been an argument that the company has been pouring too much money into both its streaming segment and its e-commerce business. The figures may shock you. For the 9 months ended September 30, 2022, Amazon North America generated $222.5 billion in net sales, but racked up $225.1 billion in operating expenses. The international segment was even worse, notching $83.5 billion in net sales, but $89.1 billion in operating expenses. Together, Amazon North America and International posted an operating loss of $8.1 billion for the 9 months ended September 30, 2022. Okay, so although AWS accounts for less than a fifth of Amazon's revenue, it is a real cash cow of the business that is bankrolling. Uh, Amazon business is hard to value right now. Slowing top line growth and losses from Amazon's e-commerce segment paired with high margins and rapid growth from AWS make the company incredibly hard to value. Due to its lack of consistent profitability, the price to sales ratio is commonly used to value Amazon. Amazon's PS ratio is right around a 10-year low and well below its 10-year median. As attractive as the low PS ratio, it's not a good enough reason to buy Amazon stock right now because PNS overweights the value of the e-commerce business and underweights the value of AWS. How Amazon can fit into a diversified portfolio. Amazon stock is relatively risky bet compared to its mega cap peers like Apple, Microsoft, or Alphabet because it doesn't generate consistent FCF or earnings. But the company has repeatedly started its long-term goals or to manage its share dilution, optimize its FCF. Over time, Amazon should become consistently FCF positive and profitable. It's just right now, the market is showing very little patience toward what a company could become and is focusing instead on what it is today. Long term investors are getting a chance to buy Amazon at a historically low PS ratio and PCFO ratio. The stock is practically the same price today as it was 4 years ago. Yet in the first 3 quarters of 2022 alone, AWS generated over 2.4 times more operating income than in all of 2018, and the company has made meaningful strides in Amazon Prime Video, advertising, and e-commerce business, even though those improvements aren't bearing fruit in the short term. Amazon is a massive business that can give an investor's portfolio exposure to so many different industries without the risk associated with investing in a smaller pure play company. As bad as the short-term outlook is for Amazon, it's still in great position to take market share during a recession. For that reason, It's the kind of growth stock that can appeal to a wide variety of investors. It can even grow to become a fundamental holding in a portfolio. So, mm, uh, current price is about price 4 years ago. It's about the same. Mm. Okay. And what else do we have? Nvidia is bottoming, but don't buy just yet. Mm. Can cheap gear maker Lam continue its rally as earnings low? The company expects a major decline in revenue due to the U.S. restricting cheap equipment exports to China. Wall Street's eyeing tepid earnings growth in fiscal 2023 and a significant declines in fiscal 2024. On the bullish side, Lam has a history of increasing its dividend since 2015. Growth in applications including AI, automotive, and 5G could also lead to increased revenue over time. Lam Research Corporation. Okay. Let's go to Yahoo Finance. Okay. Hmm. Stocks rise after December jobs report. Tesla stocks fall 66% after company cuts prices in China. Goldman Sachs says investors should buy these three solar energy stocks, sees over 50% upside potential. Uh, Dow Jones rallies in December jobs report. Tesla stocks dash new low on China price cuts. Okay, first things first. Let's look at this one. Stock market news level update. Stock rises after December jobs report. U.S. Stocks charged higher Friday morning after December's employment data showed job growth moderated last month and wages rose at a slower pace than expected. Mm. The S&P 500 and the Dow Jones Industrial Average soared 1.1% at the open, while the technology-heavy knowledge composite advanced by 0.9%. The Labor Department final jobs report of 2022 showed the U.S. economy added 223,000 payrolls last month, while the unemployment rate fell to 3.5%. Economists expect the rate readings of 200,000 and 3.7% respectively. It was the Fed versus the markets. They needed the valuations to come down. They wanted equities to go down. They wanted bonds to go down. And they wanted housing prices to go down. They got that. David Waddle, CEO of eponymous firm Waddle and Associates, told Yahoo Finance Live on Wednesday, this year is going to be the Fed versus employers. And what the Fed has told employers is, we're not going to stop until you fire 2 million people. Okay, it's all about unemployment rate, right? Unemployment rate. The December jobs report, payrolls rise by 223,000. Unemployment rate fall to 3.5%. The last read on U.S. job growth in 2022 showed that labor market remained strong. In December, even as the Federal Reserve raised the interest rates to the highest level in 15 years. Okay, labor market remains strong. Non-farm payrolls increased by 223,000 last month of the year, according to the latest data from the BFI published Friday. Economists had expected job gains to tally 202,000. So job report, we had job report last month, and it seems like it doesn't really have impact on Fed decision. And it's like Fed versus employer. Fed is like saying, we're not going to lower, we're not going to raise interest rate until you fire 200 million people. Well, it's something like that. Okay, at this point, this is it for today. I did it really short tonight. Okay. Happy Friday night, and hope you have a good one. Okay. Bye bye.